So let's start off real quickly and just define what is an Iron Condor for those of you who might not be familiar with it. And an Iron Condor is just the selling of a put vertical and a call vertical at the same time. And if you've never done one before, that might sound confusing because, as you know, selling put verticals means you want the stock price to go up. Selling call verticals means you want the price to go down. So this seems to not make sense at all. Why would I sell something where I expect the price to go up and down at the same time? And that's because our assumption with an Iron Condor is our stock price will stay between our two sold or short strikes. So what does that actually mean? Well, here's a good visual representation of what an Iron Condor is. So when I talked about selling a put vertical and a call vertical, well, this is what it would look like. Down here you see this green line. If I sell a put vertical, I expect the stock price to go up. If I sell a call vertical, I expect the stock price to go down. In this example, here's where the stock price is currently. So what an Iron Condor does is basically say, hey, we expect this stock price to stay between our two green lines, our two short strikes, over the next X amount of days until this thing expires. That's all an Iron Condor is. We're just playing for a range. And if it stays within our range over the life of this trade, we will make some money on the trade. Simple enough. Let's keep moving forward. So general Iron Condor rules. These are things to just kind of put in stone. We only sell Iron Condors. We never buy them. Volatility rank, and we'll obviously get into this in a bit, just a quick explanation again. Volatility rank, we like it to be above 50. It's a preference, but it's not required. It's just a preference. It just makes our trade a better chance of being a winner in general. But, like I said, that's just a preference, not absolutely required. We always want to sell our Iron Condors as close to 45 days as possible. And finally, probability of profit. And when we use it over here, what that means is our probability of making at least $1 profit on this trade. That's what POP actually means. Probability of making at least $1 profit on this trade. And here's a shorthand formula on how we work out the POP if our software doesn't tell us. We take max risk and we divide it by widths of strikes and times 100. Don't let this confuse you. I'm going to give you this example when we go through them. I'll show you exactly how we use this shorthand formula if your software doesn't tell you this kind of stuff already.